And those lofty levels have some Wall Street pros scared of bubbles, market bubbles. That's when investors drive up stock prices way above their true value. Remember the dot-com bubble? Well, there's been a lot of talk this week about the risks of a market bubble. Is it just talk? Here's what some big-name investors are saying.
I think the markets are bubbly. All asset prices are bubbly. Bond prices, stock prices.
At this point of time, the stock market is somewhat bubbly. It has a high cape, but we can still find low cape sectors in the market.
There is that disconnect and that sense of a bubble brewing, right? Although today, look at the market. We're essentially flat, maybe up marginally, right?
So who's right and what should you do with your money? Let's get the thoughts of two fund managers. One's a bull, the other's a bear. The bull, Vince Lowry, CEO of Revenue Shares and VTL Associates, will make his case to Tyler, and I'll question the bear, Uri Landesman, president of Platinum Partners. Gentlemen, thank you so much for joining us. Uri, let me begin with you. So much optimism in the markets right now. Are we at risk of a bubble? Why are you so bearish?
Yeah, well, I'm bearish because I think prices are way ahead of themselves. I think that they're inflated because the safety net that Bernanke and the Fed have pitched under us for a number of years right now. This too shall pass. We're at a point in the market where the market wants to hear bad news because that means the Fed is going to hang around longer. I think that that's the opposite way we should be looking at things. The market is not pricing in any chance of bad news, and I think that there's a lot more room to the downside here than to the upside.
All right, Vince, answer Uri there if you might, and specifically address why stocks have been rising so much when the economy and earnings aren't rising nearly as quickly.
Sure. The only bubble out there is in the bond market today. The stock market is nowhere near a bubble. Right now, you can buy the S&P 500 at $1.60 roughly in capitalization for every dollar in revenue. To put that into perspective, the bubble of 1999, you were paying about $2.49 to buy the S&P 500. Now, that was a bubble. This is nowhere near a bubble. The long-term history is about $1.50 when you included periods of the 70s with inflation. Non-inflationary periods, $1.25. But when interest rates were at 6%, that was considerable. Now we're at a 10-year around 250. But the most important thing, the thing that's been studied over 100 years, is that when you have a positive sloping yield curve like this, especially one where you have short-term rates, 250 basis points below the 10-year that everyone studies, that's extraordinarily bullish for stocks. Although revenues are growing slow, we've detected in the last couple quarters that they've moved from growing on average over the last 2 years by 1.8 to 2.8%. And when you consider that for the last 5 years we've been in a structured bull market and they've been cutting costs, if those revenues rise up to the normal of 5 to 7% in recovery, it's Katie Bar to do it for the stock market. If you're sitting on the sidelines listening to these bears, you're going to lose out.
Okay, Vince, let's turn back to Uri and get your response to what Vince is saying. His indicators are pretty much showing that things are bullish. A lot of cash on the sidelines, he's saying. Where's that cash going to go? Probably in the stock market, right, Uri?
Well, no, I don't really think so. So first of all, if the lead point in your argument is that this is not a bubble, and that's why we should be buying stocks, that's a fairly weak argument. I don't know which country Vince is living in, but in the one I'm in, what I'm seeing is a vast majority of America actually doing very poorly. So what we have is an economy that's giving the illusion of being okay, but actually when you look at it, it's completely bifurcated. And about 90% of Americans are actually living below their means and having less disposable income than they used to. This is a long-term, very great drag on the economy, and I don't see strength from the upper 10% and from the enterprise dragging up the bottom. And so I think this is a market that's ignoring a lot of warning signs out there and will react accordingly when people get a little more sober.
All right, Vince, quickly,
let's
get sober here.
What warning signs are out there. I don't know what warning signs are out there, but there's no statistical data to call for a bubble in the stock market. It's just not there. We're used to, during the previous 10 years, growing our revenues in the S&P 500 as a measurement around 6 to 7%. Now we're down to 2%, so we think the world's falling apart. We got people running around worried to death. don't be worried. There's a lot of good things in place. All we need is some growth. You know, maybe some of these people in Washington start some growth-oriented views of the world and provide some more growth-oriented economic behavior down there. And I am telling you, that's all you need for a very big bull market
good
that I
discussion.
think is going to go for another 3 years.
Well, there you go. There's
At
a bold
least.
call. Uri sees it the other way. That's what a market's made of. People with different opinions there. Vince, Uri, thank you very much for being with us tonight.